This is the One Point Podcast, and I'm Rohit Yadav. Valuations is a confusing and sometimes outright stressful topic for founders. And I mean, not just for founders, many VC investors also don't have a perfect grip on the topic. And due to their investment strategy setup, many investors might be valuation takers and not valuation setters. And honestly, the whole practical aspect of valuations is influenced by a lot of factors, including supply and demand of capital from investors who may or may not be too focused on this valuation as a KPI when they're doing their deals. So, in a nutshell, valuations as a topic has its worshippers and non-believers. Though whichever side you are on, it never hurts to understand the nuances from the other side, right? And that's why we have Dan Gray on the podcast today. Dan, welcome.
Thank you very much for having me. It's great to be here.
Yeah, awesome. And before we begin, let me do a short intro. So, Dan has 15 years plus of experience in and around technological startups. He's now the head of insights at Equidam, the leading platform for startup valuations, making him the perfect person to actually talk on this topic. He has co developed venture development programs across Africa, worked with startup accelerators around the world, and serves as a venture partner. He's regularly a contributor to Crunchbase, and his articles are awesome and writes about startup fundraising, valuations, and venture capital in general. So, Dan, we start with you and ask you the first question. Please introduce the platform, Equidam, for the audience.
Sure, yeah, it's an interesting story, actually. I mean, to go back a little bit further, 2014, I was at a company called Dataconomy in Berlin.
Mm-hmm.
It was and is a media platform that covers AI, big data, data science, and so on.
Okay.
Through that, I ended up interviewing Daniel Filippo. He's the CEO of Equidam. And, the conversation back then was about data-driven valuation, how, investment can be made fairer and more efficient through using data to drive valuation and, investment decisions. I so loved this concept, and it kind of stuck with me that about 8 years later, I picked up again with Daniel and, we started talking about all this. The platform itself is actually relatively simple in principle. It's a set of kind of structured methodologies for looking at valuation particularly of early stage technology companies, looking at qualitative measures, so like verifiable characteristics of a company that are connected with research-backed risk factors, and also kind of financial measures of future potential. So looking at like the VC method, which looks at exit potential for companies, for example. Then you kind of blend all these inputs, you combine it with market data. We use, public market data, private market data, process it through, kind of a really robust and transparent standardized methodology. And it gives you a result that's, the valuation, the price of the equity. And this is this is kind of like the important nuance about Equidam. It's not there necessarily to set the price of a deal.
Okay.
It's there to give you an input on like an objective valuation, and that then helps set a price, because price is influenced also by a number of other factors, especially kind of market-related factors.
Yeah, awesome. Good to hear. I mean, we obviously are going to cover this methodology and valuations much more in depth. But what I would love to know from you right now is your experience as head of insights for Equidam platform. So how has this been since you started over there?
Fascinating, in a word, to be honest. I had experience with venture capital before Equidam. I had experience with startups, with fundraising, and you kind of build up this kind of like library of like what I would call like venture dogma, all these ideas that people accept as like common wisdom about fundraising and think particularly topics like valuation. When you actually get into it and you start looking really closely at how the industry works, you see that a lot of the stuff isn't true. A lot of it is kind of misconceptions or occasionally even misinformation. And through Equidam, looking directly at like the valuations being calculated, how that reflects in the fundraising market, we do a quarterly report where we look at trends in pre-seed valuation across sectors, across regions. And when you compare that to what's being said about valuations, sometimes there's a discrepancy, and it's like you start to understand there's like a fiction and a truth.
I can imagine. Okay, so what's the vision now for Equidam platform for the next? I know 10 years is a big timeline for venture capital industry. So 2 to 5 years, like, what's the vision for you guys?
Um, Great. Yeah, it's a great question. Something we spend internally a lot of time talking about. Like overall, like the big picture mission of Equidam is to make funding for startups fairer and more efficient and more meritocratic. To give you a longer answer than you were hoping for here, like if you look back at the last 10 years, you can see a lot of money went to software companies, to SaaS,
Mm-hmm.
because basically because VCs have an easier time understanding SaaS and SaaS revenue, SaaS risks, and ultimately the valuation of SaaS companies. That's why they fund those companies more. Whereas climate tech companies, deep tech companies, quantum tech, optical
Yeah.
computing, all these fields, they don't understand so much. So they don't fund them as eagerly.
Mm-hmm.
If we can help investors better understand those companies, then we can more efficiently make sure capital gets to them and builds the important things. And that's, I think, our long-term mission. In 2 years, if you bring it back to that kind of time scale, there's smaller pieces of the problem we're targeting, like valuation for employee stock options. That's something we're looking at a lot at the moment, mostly for Europe, because it's growing in adoption in Europe. The frequency with which companies issue stock to employees, it's
Yeah.
growing, which is great, but not as fast as it could. And a
Okay.
part of that is the cost and the time involved.
Okay. Understood. So the goal for Equidam platform is, or the vision is to increase the fundability of startup across different areas and sectors. Yeah. So obviously, deep tech and certain kind of areas are not from a valuation perspective comparable to SaaS, obviously. And as you said rightly, most of the investors actually started, or they have most of their experience from the SaaS background. And even actually, data out there supports SaaS startups in a way because it's much more transparent, it's much more available, right? And you can easily find those kind of valuation parameters like ARR, multiples, and so on. So it's much easier to compare the startup which is in front of you with those KPIs. It doesn't work the similar way for everybody. So I think you guys are doing a fabulous job over there, and I really wish you the best that you achieve that.
Thank you very much. Yeah, we need all the help we can get because it's a battle. Trust me.
Awesome. Awesome. Let's start the valuations from a very practical example and let's spend some time. First, tell us about the different valuation methods that you are using behind the scenes in Equidam. We don't need to go in technical details. Obviously, anybody who wants to have a look, they can log on to Equidam platform. They can subscribe to you guys. From a very high level perspective, there are multiple ways of valuation. Can you tell us more about that?
Sure, yeah, and without getting too technical. So the main kind of thrust of how the methodology works is this balance of qualitative versus quantitative inputs.
Mm-hmm.
And essentially that's because across the lifetime of a company, if you think about like a pre-seed idea stage company, you have nothing to value except, the strength of the team, their expertise. Maybe you could look at the competitive environment that they're entering into, maybe IP. There's these kind of qualitative factors, and that's all you really have to look at.
Yep.
Compared to if you go all the way up to, a pre-IPO, like just pre-IPO company, at that point you're looking at essentially like the quality of the cash flow, and that's it. You no longer really care that much about the strength of the team as such anymore, because the more mature a company gets, the more the strength of the team is translated into financial performance. So
Right.
that's kind of the basic logic of how we work, going from the qualitative methods like a scorecard and checklist, which are developed by renowned angel investors in the US for looking at early stage companies. Then,
Mm-hmm.
through the venture capital method, and then ultimately DCFs, discounted cash flow methods for more mature companies.
Okay. Got it. So basically, tell us more about the scorecard. So, for example, let's say there is a founder and he or she wants to understand how the scorecard is rating them, right? So, can you tell us what are the parameters on
Mm-hmm.
which they are rated from within the platform in the scorecard method?
Yeah, absolutely. So, quick overview of how it works, just to like give context, is Scorecard uses an average valuation as a benchmark, And then it uses, I think it's either 5 or 6 parameters to adjust against that benchmark valuation. So that would be things like how many years of experience does the team have? Have
Okay.
they worked together before? Have they founded a company? Is the market that they're entering, is there a lot of competition? Are there high barriers to entry? All of these kind of qualitative factors that then adjust against that outcome.
Okay. And so let's cover the process of one startup coming on the Equidam platform. So are they supposed to just input these parameters in the platform and then get like a sample outcome of what the valuation range might be based on different methodologies? Or are they asked to rate themselves in terms of, as you said, how tough the competition is out there and so on? So what I'm trying to understand here is how much of that is driven by your platform itself, how much of that knowledge or scoring is done by the platform on different areas, and how much of input is required from the founders.
So I would say, that there's something like, I think it's 34 questions, mostly multiple choice. That covers the kind of qualitative side. So it's
Okay.
asking things like, how likely are customers in your market to change between different solutions? That's one of the kind of qualitative inputs that we use.
Okay.
So they fill in this questionnaire that then kind of goes to like a scoring algorithm
Okay.
that produces the adjustment against that benchmark valuation. So they're not scoring themselves necessarily. They're trying to give the
Got it.
most objective answers they can about their scenario.
Got it. And so from an sample outcome perspective, explain to the audience, how does a sample outcome look like and what should the then founders do with that?
Yeah, it's an important question for sure. So the kind of output that we have is a 25-page PDF. So it's
Wow.
comprehensive. It's
Okay.
super comprehensive, deliberately so, because we want to make sure you can look at that PDF and you understand all of the inputs, all of the parameters that we use, all of our data sources, how often they're updated, all of the calculations, like everything is in there, because
Wow.
transparency is, crucial for this process. If you have a situation where different parties in a transaction feel like they have different levels of information, you end up with adverse selection, which drives down prices, which is not good for the market. So we try and introduce as much transparency as possible. And this PDF is not necessarily even something they would like give to an investor.
Okay.
They can use it just to inform their own expectations, give them an idea for what they might be heading for in a negotiation. But if they find an investor really pushing back on the value, then they could say, look, this is what we've used to calculate. These are the drivers of the value that we've presented. If you think our value is lower or higher than we've said, now you can talk about where and why potentially, which is a much more productive conversation.
Okay. So how should founders tackle this question of higher and lower? Because most likely when the valuation from the investor is kind of within that range, it's okay. The discussion it's not that kind of pressing. But when it goes towards the extreme on the either side, it becomes kind of a pressing discussion. So, how would you kind of suggest the founders to look at the outcome that Equidam platform is providing them? How would you then recommend them kind of discussing on sample parameters on why it should be lower and why it should be higher? I mean, I can imagine a situation where the founder, let's say the first time founder, they might not have that much of handle on this valuation topic as compared to the investors who are probably doing this every week, right? So how do you suggest that the founder should go about it?
It's a delicate issue. It's always a negotiation, and both sides have to be kind of sensitive about the topic. But I think the main thing is, and this is advice we give to everyone we speak to, really, before you even think about fundraising, you need to have some familiarity with the market. You need to understand
True.
who some comparable companies, what have they raised? If you can find the terms, that's always useful. Get an idea for the kind of valuations a comparable company might achieve. And is that within your expectations? Is it near your expectations? If so, good. If not, you may need to really think about it. A lot of companies, for example, will approach VCs or angels looking for investment, and they're not even really like a venture backable company. And that's a big problem for VCs. They want, billion-dollar outcomes, if not multi-billion-dollar outcomes. And if your company isn't on that path, you're wasting your time, frankly. So that's, there's a lot of questions to be asked before you even get into kind of specifics of valuation. Once you are in a negotiation and you're talking to an investor, and if they really push back and they say, we think your valuation's way too high, first you have to understand that's their incentive. They want more ownership, so they are often going to do that. If you have competing, if you're talking to multiple investors and you can get some competing bids, of course, that's always helpful. Get a bit more of a range. But really, it's going to come down to having a solid objective view of the company and of the market, combining those two, and then you should get a fair outcome.
Okay, got it. Let's capture two important points over here. So the two extremes, right? And obviously you don't have to be too objective about this because we are not having a concrete example. What do you suggest to founders when an investor comes to them and says the valuation is too, let's put the valuation which is too low, then outside this range of what you guys have suggested? So how would you suggest the founders should go about it?
Well, a simple response to that, honestly, is to think about dilution. It's very important that founders retain enough of a stake in their company over time to stay motivated, to feel like with all the blood, sweat, and tears they're putting in, when they get to that eventual exit, they're going to own enough of the company to have made it all worthwhile. And investors should also appreciate that too. If an investor's pushing back on valuation, it means one of two things. They don't believe in the same value at exit, or they don't understand how much capital it's going to take to get there. They may be underestimating the amount of future dilution you'll need to take. And that's, again, it's a conversation you have to have with openness and with transparency. And good investors will be receptive to that. They care about the long term of the company and about the founders.
Okay. And this could be a case where, for example, founders are raising on a price round 1 million, let's say euros, and the investor is pushing for just a 3 million kind of post valuation. So it would be like around 33% dilution, right? And it would be just too much. So if you look at the common parameters of dilution at the very early stages, it could range anywhere between 15 to 25, depending upon different geographies, depending upon which areas that the startup is working on, the market environment, and so on. But typically that's the kind of range. And if it's on the extreme side, as you said, then the founders are diluting themselves just too much. And they are not understanding how much the more dilution is ahead of them, right? And they might not be left with enough equity when the exit happens. And obviously, there's kind of an inherent motivation on owning the equity when there's an exit. Otherwise, as you said, why is anybody like putting their sweat and tear on the startup, right?
Absolutely, yeah. That goes back to the employee equity as well, which is increasingly important.
Yes.
You're going to need a pool, and probably that pool is going to get bigger over time. That's another chunk of equity that will be gone. But the other thing I would add is, the 15 to 25% is, you're absolutely right. That's the standard. But it's also important for both investors and founders to understand there are always exceptions. And if you imagine, for example, some hardware companies may need to raise more money upfront to begin manufacturing, to get the materials and the machines. They may need to take more dilution in the beginning, with the obvious consequence that they take less later as well. So it's always a bit scenario dependent too.
Awesome that you mentioned this point, because when founders come on your platform and upload the details, they get this. They will get the solution, or the output will be according to their field, whether it's in hard tech, SaaS, and so on. So they don't have to worry about 15, 25. They actually just, everything is included, kind of pre-built or baked into the outcome, right?
Yeah, pretty much. It's a bit dependent on, really a lot of this hangs on the financial forecasts, the projections, which is an area of venture capital where not many people have like a super well-informed or well-refined opinion, because it's difficult, it's time-consuming, it's complicated, but it's super important. It's how you understand, what the future of your company looks like,
Yep.
what the potential of your company, why are you raising the money you're raising and how is it going to be spent? Like all of this story about the future told in numbers is in the projections. And that's kind of the core of valuation, however you do it, whether you do it through Equidam or not.
True, true. And jumping on the second extreme, where the valuation offered by the investor is, let's say, on a very high extreme. I mean, it can happen. I know it's not in the perfect scenario.
Mm-hmm.
So, what would you suggest to founders in this case? Let's say they are raising 1 million and the valuation is offered at 8 million post, for example. So, how should
Mm-hmm.
founders approach the situation then?
Yeah, we saw a lot of that in kind of the 2021 era, of course, like when valuations got a little bit crazy. And a lot of founders regretted raising at particularly high valuations, mostly because the bar you set yourself at the next round is even harder. If you imagine a pre-seed company or a seed company raises it, let's say 5 million post money, the investors are going to hope, or going to aim for, it'll be 15 for the Series A. They want a X or a 4X, something like that. So if you raise at 8 or 10 in the previous round, suddenly you're looking at having to raise at 40 in the next, just to keep your investors happy. And that's kind of like a crude way to look at it, but there is truth to it. It's like life is much more difficult at that point. And if the market takes a downturn, as they found out a couple of years ago, it's a nightmare.
Do you think investors have investors have more incentive in giving the valuations lower because then the jump looks higher for their fund, right? The markups look much better in the next round. What are the incentives of giving a higher valuation? And that's a tricky one.
Yeah, it is. It's an interesting one. I mean, essentially, this is like a very deep part of the conversation, but a very interesting one. The incentives essentially are, if you're the first if it's the first round that you invest in, you want a low valuation typically because you want more ownership. If you are investing in an existing portfolio company in a subsequent round, this is where it gets tricky, because either you again want a low valuation because you want to increase your ownership, or more often you want to push that valuation up so you have the bigger markups, so your fund looks better to LPs, so you can raise more funds, get more fees, etc. The exception to this is the largest funds, like the big multi-stage funds like Andreessen Horowitz or Thrive. They're kind of valuation insensitive always. Even at the first round at seed, they may give a high valuation just to justify pumping more cash into the business, because they're backing this company. They want it to be the winner in the market. They want it to dominate. So they will give it as much money as it needs to do that, which may mean giving it an unreasonably high valuation.
Yep.
And they can sustain that because they'll do the next round too at another high valuation, and the next one, etc.
Awesome that you mentioned this, because it's so much important for founders to understand when they're raising capital from multi-stage funds versus other kind of specialists at pre-seed or seed stage. There's a competition, and this competition has increased tremendously in the last few years. And as you said rightly, just because of the sheer amount of money, capital raising power that they have, the kind of status that they have built within the industry, multi-stage funds might be able to give more capital because they want the startup to do well and so on. And for the specialist funds, it might get trickier because they have their own kind of targets of how much they want to own of that round, and they have the limit of how much amount they can invest in that round of a startup. And if they invest too much, then their kind of portfolio gets a bit screwed up in a way. So they have their limit on how much they can invest in a round, but multi-stage don't, and they can invest, let's say, 2x more. It's just a theoretical kind of exercise right now, but this additional injection of capital will definitely result in a higher valuation. And then it depends on the founders themselves to analyze whose term sheet will they be more willing to accept. Multi-stage investors are seed investors, specialist ones, high valuation, low valuation. And that's something, now I'm throwing it back to you, that's something that Equidam platform cannot solve it for the founders, right? I mean, you can give them a range, but then it rests upon the founders themselves to talk to other people within the ecosystem, talk to their peers, talk to other founders who have raised in the similar area and so on, talk to maybe some angels, talk to some people who know the business on how this economics around the whole situation goes and what parameters would then end of the day result into, right? So if you can say a little bit about that as well.
Sure, yeah. I mean, that's really getting into another interesting topic, which is the question of price versus value. So Equidam, as I said before, our intent is to provide an objective value for a business, which is not the same as price. Price is the number you see on the term sheet. That's the amount at which the deal is closed. And valuation is a component of price. It plays into it. But there are other components too, like, for, let's say, an example company with a valuation of 10 million, just to keep it simple. A smaller VC may be willing to do that deal at 10 million or may negotiate it down to 9, whereas an Andreessen Horowitz may do 10 without thinking, just because they have the capital to do that. Or they may even do 11 or 12 if they think it needs more money. Also, if you have a specialist VC with a portfolio of companies all aligned around a specific theme, if your company that you're raising money for really fits that theme and is very synergetic with the other businesses, they'll be willing to pay more. That's another way in which price is distinguished from objective value, let's say.
Got it. And next question actually chimes in well to what you said, right? So startups are art, valuations is science, and price is both. So this is an article that you wrote in Crunchbase, I think, right? Tell us more, like elaborate this one single line. It's so powerful. Elaborate this for the audience. What does it actually mean?
Yeah, it's kind of a philosophical point really about fundraising and venture capital. If you speak to, well, in fact, you don't even need to. If you look at any conversation about fundraising, startup fundraising or VC in the last decade, investors will talk about deals done in terms of valuation. They'll say, this investment was made in this company at this valuation. They won't say price. What they really mean is price. Price is what is actually paid. Valuation is the objective value. That there's the difference between the two, and the conflation of the two, the confusion of the two terms, I think has really hurt the ability for investors to understand the nuance of what they're doing and the kind of value that they're getting when they invest. The valuation is kind of scientific. It's methodical. It's a process. You can see it in a report. Price is more kind of art because it's more subjective. It's based on the conditions of the market, of the fund, of the portfolio, lots of these factors where there isn't a clear calculation. And the startup itself, understanding the vision of the founder, that's when it's kind of like art. And you have to really build a mental process to combine all three to get the full picture, I think.
Okay. What do you suggest founders to do in such situations? Have you heard, because there are a lot of founders coming to your platform and so on, so there could have been instances where you would have deeper discussions with some of the founders. So tell us a couple of examples, struggling thoughts from founders, if I may say, which they have come up with and discussed with you, and what was the kind of solution in the end to valuations of the topic. So the theme is still valuations.
Yeah, I think the most common one really, and funnily, we tend to get this more with founders in Europe, is they've come away with a valuation that is too low and they're not sure why. And the reason this tends to happen more often in Europe is because European founders are simply less likely to be optimistic, which is quite funny.
Well,
American founders, even founders that we talk to in Southeast Asia or Middle East, they tend to have a more balanced perspective. American founders, by far, the most optimistic about their own potential in the future. Europeans, pretty pessimistic. It's funny, like you have to understand, if you're approaching investors to get them to back your company, to give you money to grow, you should be optimistic. If you're not optimistic, how can you expect them to believe in you? That's like a common theme, I would say. The other example I can think of, and this is an increasingly common one, is deep tech companies. So I can think of a biotech founder I spoke to a couple of weeks ago. He's in this category of startups where the risk is super front-loaded. Like all of the, well, not all, but the majority of the risk is in like getting through clinical trials, getting the drug approved, then getting out to market. If they get through those first steps, like the future of the company is looking pretty good. But if they don't get approved in the clinical trials, it's game over. So how do you approach that in terms of valuation? And then you've got to think about doing different scenarios, like what are the percentage chances for getting through different stages of clinical trials, applying that to different valuation scenarios. It gets more complicated, but it's still doable.
Okay. So let's focus on the first example because it's super interesting. You said founders in Europe are a bit pessimistic about their valuations.
Mm-hmm.
I want to double down on this topic. In what scenario can this happen? So, for example, I'm a founder. I am there to raise, let's say, 500K. I mean, it's more likely to happen at the very early stages, right? And then let's say I'm unable to find a lead investor who's a setter of this valuation, right?
Mm-hmm.
And in that case, I'm talking to, let's say, angel investors or maybe some other investors who are not, let's say, doing it on a full-time basis, right? High net worth individuals and so on. And obviously, those investors don't have a very good handle on the valuation part of it. They have a very good handle on how much money they can invest, obviously, because that's their money. And so in these cases, like the founder then needs to come up with a certain kind of valuation in their mind. And so this is what you want to say when you say the founders are pessimistic, because if, for example, the term sheet is already given by the investor themselves, then there's already one figure in front of them and they can hinge on that figure and just go around it, talk about it. That becomes like the discussion point, right? So
Mm-hmm.
can you explain this a bit more?
Yeah, absolutely. So it's more in terms of the financials, basically. So when they're looking at putting together their data room to talk to
Okay.
investors in the first place, they're going to have projections in there, and
Yeah.
their projections are much more likely to be conservative, which is not necessarily the right move.
Got it. So you're more focused on the financials that they're mentioning, that they're very conservative on that side of it.
Mm-hmm. Yeah, exactly. On one hand, more conservative financials will pull down the valuation, which in a sense is good for investors because then they get more ownership. On the other hand, it goes back to the point about that need for multi-billion-dollar exits. If it's not pointing towards that, then it's of no interest at all.
Okay. And now let's jump on one of the methodology of valuations. And I want to mention here another article of yours, which is like how venture capital abuses or uses revenue multiples. I thought that was a very nice way of mentioning that. So most of the way it happens is like revenue multiples they are an easy way out, right?
Mm-hmm.
They're an easy way out. DCF, projecting your cash flows is always more trickier part to it, which not a lot of people will be able to handle it. But multiples is much easier kind of approximation into all of this exercise. So tell us your thought process behind writing this article, and why would you suggest founders not being dependent on multiples, and in which cases you would actually suggest them to use such things?
Well, I think the first thing I'd say is it's not necessarily a founder problem. This is an investor problem. Investors, venture capitalists are the ones who use and abuse multiples too much and too often. It's an interesting topic. There are a number of different components to it. The first is how multiples are used today is very different to how they were used historically. If you look at multiples in public markets, if you wanted to, and this is really where this is the root of multiples. If you wanted to compare Rivian versus Tesla, you might say, they're both Tesla's trading at X, its past 12 months revenue. Rivian is only trading at 10x. And then you would use that discrepancy between the two to say, okay, clearly public market investors are much more optimistic about Tesla. Why is that? Why is that the case? Okay. They're a tool for comparison is the point, really. It's a way to get a quick look at two companies where the valuation and the revenue. The revenue multiples are just a tool to compare them. That was the original purpose. And you can go back and read, there's a blog post on the Andreessen Horowitz blog talking about entry multiples. And they make the same point. Like, multiples are a product, an outcome of valuation. They should never be an input. However, you look at how they're used today, the most widespread use is, oh, you want to invest in a company at seed, the comparable analysis tells you it's a 10x on revenue. So you apply a 10x multiple to the revenue and you get a valuation. And it's super easy. It's a good way to get a lot of deals done quickly, which was great in the kind of decade of low interest rates. But it's crude. It's kind of completely inappropriate, really, because revenue at early stages is volatile, unreliable, grows quickly. It's not what you should be associating value with.
Okay. Tell us situations where multiples might be, I know you kind of mentioned this already, but where multiples might be more useful and situations where multiples are less kind of useful. And is ARR like multiple more focused on certain areas of the venture industry? And if, for example, investors or founders are in the other areas, which are those areas where they should actually not look at those multiples?
I think effectively multiples become more useful the more mature and well understood companies. So roughly speaking, kind of Series C and beyond, and especially for like SaaS companies that are very well understood by investors, multiples at that point, are what they lack in like specificity is made up for by the fact that they're working with much more reliable underlying data. At pre-seed, seed, even Series A, they're not really going to tell you anything useful. I think to a large extent, they are used to justify the valuations that VCs want to give anyway. They're not really doing any of the work. It's just there as a tool to justify the price. However, there is an important difference between that use of multiples, which is multiples on current revenue, versus how we use multiples at Equidam.
Okay.
We apply them to future revenue. Because, today's revenue at a seed stage company is not a useful metric, as I said. It grows quickly, especially if it's hard tech or deep tech or biotech. Their revenue could be zero for a long time. You can't put a multiple on zero. But if you look out to 3 years in the future, 5 years in the future, you can start more usefully applying multiples to that, especially based on public market data.
Okay.
Then you're getting a much better understanding of exit potential in the future. It's always a case of these methods are going to lack some specificity, some detail, but it's about finding the most useful and informative way to use them.
Got it. And so founders, it's very important to understand, as Dan explained, like there's certain areas of the market where those multiples are actually used quite often. And we would see that in the reports as well from very well established data providers, that it's used very often, but it's not applicable to all the areas. Like, as you said, deep tech and so on, there are different cash flow behaviors, and multiples might not be useful. And the second case is it's not really useful pre-seed stage. So if there is an investor who wants to talk about such multiples, then I think there needs to be an argument or discussion around this topic on why based on this multiple and what's the significance behind it and so on. So be prepared to have that discussion. But the first point is always, to know that when to have a discussion, right? So
yeah, exactly.
Good. Any other questions that pop up from founders time and again regarding your outcome report, 25-page report, and founders are, let's say, typically asking you questions about?
Easily the most common question is, how is an investor going to respond to this report? Founders want to know, do investors like the methodology? Do they trust the data sources? Do they think the calculations are done correctly? All this kind of thing. This is usually the main concern.
Okay.
And the answer to this is not simple. Nothing is simple about this, of course. There are basically like two categories of investor. There are the I would call them like the Gen Z investors, the people who have entered venture capital in the last 10 years. Their only experience is like ZERP investing and doing valuation with multiples. And they don't know what to make of it necessarily. But they need to sit down with the founder for half an hour and go through it and really talk about all the detail. And then maybe they can come together on what the output means. The other group are either the older VCs or VCs, particularly those with a financial background. They get it straight away. They understand the methodology. They know exactly what the intention is, and they see it as like a practical, pragmatic tool. And increasingly, they're using the tool themselves to inform the price
Okay.
they pay for deals too.
Okay, got it. So now this brings us to a very important part of the discussion, the valuations that have been there recently
Mm-hmm.
in 2024, 23 time period. What happened to them? So now we are talking more about the current data as
Mm-hmm.
you are seeing in the market based on the current discussions, based on the current founders that have reached out to you or on Equidam platform versus what was there in the 2020 and 2021 phase. So
Mm-hmm.
how have you seen valuations evolve? And take a two-sided view, Europe versus US, if it's possible for you, like talk about both those areas as well.
Yeah, absolutely. There's a number of different ways to look at this. I think one interesting one is early stage versus late.
Mm-hmm.
And so we spend quite a lot of time looking at data for pre-seed. It's kind of the sector we do the most, so we have the most data. It's also just generally very interesting to get an idea of the health of the market. But also on the other hand, late stage valuations are where there's been the most turbulence and probably the most headlines in the last few years. And the difference between the two is essentially late stage companies are much more dependent on kind of macroeconomic conditions, the health of the exit market. So the fact that IPOs have been so slow, M&A has been slow, that's really hurt late stage venture backed companies. On the other hand, pre-seed is almost entirely disconnected from that because they're 10 years out from an exit. And who knows what the market is going to look like in 10 years. What we see there, and this is where patterns emerge between regions as well, pre-seed valuations are significantly and surprisingly correlated with optimism.
Okay.
So we saw, for example, Q2 2022, which was the period where things looked really bad. Y Combinator sent out the letter to its startup saying, like, brace for the worst, get to default alive. There was a big dip in pre-seed valuations. Came out of it pretty quickly and has, on a global level, been virtually flat since the start of 2023. If you look at the US, quite a lot of turbulence, but broadly trending up because the US is, as everybody knows, the US for always optimistic, very bullish about technology and private markets and capitalism.
Mm-hmm.
So their valuations steadily trend upwards, and that's been the case for a long time. Europe has actually been trending downwards for the last 4 years, which is not a happy place to be. Should really never be the case, not over such a long time. But it speaks to, I think, deeper concerns about, perhaps regulation, growth of technology and technology investment in Europe.
Okay.
There generally just isn't as much optimism.
Okay. So you want to mention optimism as one of the key points which is driving the valuation as a topic, but it's also dependent on, let's take another side to it. So there's startups who want to raise capital, and that capital, a lot of that is the labor cost or the people kind of talent cost, right? That's not decreasing. That hasn't decreased so much in the recent time. Might have been stagnant in Europe, but in US definitely increasing and so on. So the drop in the valuation is not justified from the more macro perspective of things. So would you suggest, I mean, it's kind of a very long shot, but would you suggest founders to build startups when there are better macro conditions than not better macro conditions, right? Like how should founders think about all of these topics? Because a founder never thinks about macro topics. When they are starting a startup, especially as you mentioned, you're in pre-seed, you have the best data. They are not thinking about how the environment is. If there's an idea which clicks in the head, if they think there is a need in the market, they would be on top of this. But my perception is, I mean, we can, as founders, nobody can fight the macro stuff. You can navigate the macro, but you cannot fight the macro. And so from that perspective, do you have any suggestions for founders who are starting in different cycles of the macro conditions? I know it's a loaded question, but
That's a good question. It's to an extent, none of it is rational. As I said, it's really the late stage companies that have that connection to macro conditions. But if you're a pre-seed company and you're raising money at a time say for example, you're raising in Berlin, and at that point in time, Germany's economy is booming, the EU as a whole is booming, and everything's looking great, everybody's happy, everybody's positive. Investors are going to more easily buy an optimistic story about your future than if there is like generally a sentiment of negativity, even though that's not really rational, because a pre-seed startup is not connected in any meaningful way to the macro conditions of the time. So to your question about like, does that influence when you should start a company? I mean, there are definitely times when it's easier and when it's harder. I think it was relatively easy to start a company in 2021, much harder in 2023. But really, like, being a founder and being a successful founder of a great venture-backed startup is about being an exception at the end of the day. And you have to embrace that. Like, whenever you're ready to do it, you should do it. And if the environment's hard, well, you're going to be a tough founder.
Yeah, that's what I wanted to hear. That is what I was expecting from you. So valuation, pricing, and so on. I mean, they are very critical, important points, but the founder's story is unique in itself. If you have an idea, if you think that you're exceptional, go for it, because it's just valuation is just one input to it. I want to touch upon one more point, and maybe take your advice on it. What you have seen in the market is, do you see pre-seed founders in Europe going more for the US based investors or US based kind of angels and high net worth individuals, and trying to capture on this differential between the European and the US optimism, right? Do you see this happening more and more? Do you envision this, that in next 2025 maybe this happens much more as the economy opens, as the venture capital ecosystem becomes more kind of globalized, right?
I think it depends a bit on the sector that you're in. For example, if you look at, defense tech, you have Helsing there in Germany, which raised from US VCs pretty early on. It's essentially because defense was a very hot theme. There was a lot of interest. They managed to they used that story of like, we could be, well, I don't know if they said this, I'm kind of putting words in their mouth, but like they could be like the Anduril for Europe. Similarly, you have Mistral in France. They kind of had the narrative that they would be the OpenAI for Europe. So they can use those kind of narratives, especially if they're in a super hot industry that every investor wants to back the winners in. They can appeal to any investor they like. And that means, yes, the ones with the most money are most valuation insensitive in the US. However, what I would add to that is if you look at a valuation on a company, it should change based on where the company is. The market conditions of where they are, things like currency stability, political stability, all of these things should and do factor into valuations. So it's not necessarily the case that if a European founder goes to raise in America, they'll get American prices.
Got it. And do you see this differential getting closer in 2025?
I think so. I think that there's a good case to be made that it's getting easier to do VC internationally, that markets are generally more democratized over time. And then it becomes a question of like, where's the opportunity for VCs? And with this worry about lack of growth in Europe, perhaps it's not Europe so much. Maybe they're going to look more to Latin America, to Southeast Asia, but anywhere where they feel like there's a real path to growth. I think that's where VCs will go. And it is getting easier to work internationally.
Yeah. I mean, you captured a very nice point that, capital kind of has its way of finding the best opportunities, right?
Yep.
And if it's not in one geo, then they will find another geo, right? So that's how LPs are. That's how the GPs, VC GPs are, and so on. We talked a lot about founders and valuations. Let's take the side of the investors as well. What have been your discussions with investors based on the report that comes out of Equidam, for example? If you have had discussions with VCs who have used your platform to build a custom report and so on, and what are their biggest pressing questions regarding valuations at the top?
Yeah, again, like on that side of the industry, it's kind of they either get it or they don't. Most of the time, the ones that do, yeah, they're kind of familiar with the methodology and how it works, and perhaps they were even doing something like that in Excel before, and they come to us just to streamline it.
Okay.
However, I would say that since 2022, when there was that initial real dip in the market and a lot of concern about how Web3 investments, creator economy investments, micromobility investments, like suddenly real concern from LPs about how are those investments doing? What are they marked at today? And what are those marks based on? Real worries about that, especially because you have LPs who are invested in multiple VC firms who may be invested in the same company.
Yeah.
So then the LP sees different perspectives on how that's marked, and they're like, where is the standard? Like, where's the logic? Where's the rationality behind this? 2022, we see more investors coming to us to say, hey, like, we need a way to standardize reporting marks to LPs. And that's where the value of that, like, standardized methodology really comes into play, and the transparency. It's great for that purpose.
Okay. So in 2022 and 23, obviously you rightly said it was in news as well that a lot of VCs are marking the same investment differently. And I think if I remember correctly, some VCs marked them up as well, while most of them marked down. How do you see these things happening? I mean, obviously, when there's kind of a downturn in the market, these things become a bigger concern for LPs as well. It's more in the news because your reporters want to focus on things which are not functioning properly, right? In 2025 and moving forward, how do you think this topic of differential marking the same investments will be important to the industry?
Well, if you'd asked me that question 2 years ago, I would have had a more optimistic answer for you, because the outcome of that dip was a lot of LPs asking those questions, a lot of kind of conversations springing up around that topic, things like standardized valuation, fair value, even people beginning to talk about concepts like the difference between value and price. Unfortunately, what then happened was OpenAI released ChatGPT, and the market became obsessed with AI. And all of the same problems we had in 2021 appeared again, like insane pricing, massive escalation of pricing for startups, without doubt a bubble of some kind. And suddenly all that mattered once again was getting into the hot companies at any price. And fair value, not so important. What the marks are, not so important. All that matters is, are you invested in OpenAI or Anthropic or Cohere or Perplexity? If not, you're not doing well. If you are, great.
Okay. So that kind of screwed up with the with the topic itself and the ability to, I mean, I don't know whether to say it is a feature or a bug for the private markets. It has always been this way. I remember in private equity as well, when we used to have discussions, is the same case for other more stabler alternative investment asset classes as well. So I'm pretty sure this topic is not going anywhere. It might become more relevant and standardized in the processes. So LPs for their own reports might use tools like yours or other kind of standardized features, because if VC as an asset class expands, it becomes a bigger portion of their AUMs, and then obviously they need to rationalize all this process, right? And it becomes much more important, and they have much more deeper discussions, and there might be like more consulting companies talking about these topics as well, or consultants. I want to talk about this secondary part of the business and whether you are focused and to what extent you're focused, or if you're thinking about that you will focus on in the future, because there's a lot of activity which is happening now in the secondary markets. And taking what you said right now a couple of minutes back is that especially the retail investors who are investing in big names, famous names in secondary markets, they are very insensitive to the pricing at which they are going into the market. And according to some reports, they are going at, X what they should, for example, right? How do you see, or how can you capture on this opportunity?
Yeah, it's super interesting topic. Again, like, this is another one where you can get into price versus value with what you just mentioned about them going in at a 2x kind of premium on the supposed market price. There's a kind of longer story here about multi-stage funds and what they've been doing for the last year. But one thing is for sure, if you look at the the 10 firms that raised the most money this year, they didn't raise any money, or like one of them raised money in 2023, because what they were busy doing was consolidating their portfolio, like selling off stakes in stuff where they could to get money, and buying positions in OpenAI, in SpaceX, Cohere, etc. Like whatever the hot names are.
Okay.
Then this year, they can go out to LPs, and they raised a record amount of money this year because now they're showing portfolios that have all the great logos, and it looks great. So then, like that 2x premium now makes sense. Like they were paying to be able to raise more easily this year, essentially.
So it's a name game, right?
Yeah, pretty much. Like sadly, but also it's kind of understandable. I would love shares in SpaceX. Let me tell you.
You're a Tesla. You're an Elon Musk fan, I think so.
I'm a SpaceX fan.
Yeah, SpaceX fan. Okay, got it. Would it make sense? And I know this is a podcast, and it's not a way of throwing it out there, but maybe your platform, does it exist? I don't know. You can just write reports on pricing. What's the right pricing for these top tier kind of big names? Because you can easily get the data and just put it out there for the market to see on a quarterly basis, right? And that does the job of educational. It's a bit of a marketing hype as well, but I think it goes in the nuance of making everybody understand the ecosystem of what they are actually doing. It should be based on fundamentals of investing, risk, and so on, and not just emotional investing. I don't like emotional investing. I'm not an emotional investor at all. So this idea of valuations, pricing, where they are going into makes much more sense. And I think this is doable for big names because data is readily available, but it's not doable for pre-seed, for example. So maybe that's a topic, or maybe you guys are already doing it. I don't know.
It's an interesting idea. We don't do it, and the reason for that is essentially because there is more data on those companies, the big names for sure, but there isn't we don't have access to their financial projections for the next 3 years, and that's what we would need to provide a valuation with a degree of confidence. We could probably provide an indicative valuation, what a rough calculation, what we think someone like a SpaceX is worth. But then it gets tricky because it really becomes a story. Like if it's SpaceX, it's a story of how much do you believe in Elon Musk? If it's OpenAI, it's how much do you believe that general AI is close? AGI, sorry, is close. And that, it strangely becomes very subjective at that point.
Understood. Good. Dan, it was great talking to you. One last question, and it doesn't need to be focused on venture industry valuations as such. I love to ask this one topic. If you have heard, listened, or read something super interesting recently and that you would like to share with the audience, what it could be.
That's a great question. And I'm actually well positioned to answer it because I have a number of books on my desk next to me, which I'm reading at the moment or have read recently. So I'll give you this one. This is Paper Belt on Fire by Michael Gibson. He's the GP, or one of the two GPs at 1517 Fund. He was previously at the Teal Fellowship, and he is an incredible investor. His firm is brilliant. His partner, GP Danielle, is fantastic. To give you an example, the kind of investing they do is they will meet a high school student who has a really great idea of something they want to try, and they'll Venmo them $2,000 just to buy the equipment and try it. Like when you talk about early stage investing, these guys are insane.
That's early. That's really early.
Super early.
Awesome. Thanks for mentioning it, Dan. Thanks for joining and letting us know all the nuances of the topic of valuation. I know there's so much more. Obviously, this is not a promotion for your platform, but there's definitely a worth in checking out more topics like valuation and getting a rational kind of outcome based on where your startup is and so on. It also helps founders to do a better discussions with investors if they are on the extremes, as we discussed within the podcast. So all in all, founders should definitely look at this topic much more seriously, and so do investors. And thanks a lot for joining in, sharing all the details.
Thank you very much for having me. It was a pleasure. And as you know, I could probably talk about this for another 2 hours. So maybe another one in future.
Definitely. Dan, thank you so much. Take care. Bye.
Thanks a lot. Thank you.